What's up, everybody? Dave Bartosiak here with another edition of Zach's Live Trader, back from Sunny Isles Beach, Florida, where I got no tan at all whatsoever. Still pasty, but it's because I was working while I was down there most of the time. And, nice little change of scenery. I'm hoping that you guys, as members of Zach's Live Trader, got a chance to see our review video last week. That one I did go ahead and Skype in, or we meet it in, one of those. We use something to get me live from Sunny Isles Beach. But now I'm back here and back in the studio for an action-packed agenda today. We're going to be talking about Salesforce.com, ticker CRM, and Foot Locker, FL. But first, Salesforce. So again, guys, if you're not signed up with us on Zach's Live Trader, that's where you're going to get, not only, of course, you get to see these videos, because everybody gets to see these videos, but you're going to get one premium stream a week that you're not going to be able to get anywhere else, plus that weekly review, which this week is going to be huge because this is the regular monthly expiration. So that third Friday of the month is always going to be jam-packed with options trades that are expiring. So this is a big one. I got a lot of work to do tomorrow, folks. It's going to be great, though. So again, if you have any questions about that, how is it that you can get signed up on that, send me an email, livetrader@zax.com. That's livetrader@zax.com. I'll let you know all about the $9.99 per month hookup on that, plus a 14-day free trial. So if you don't like me after 14 days, you don't have to worry about it. Just tell me to go away. But I think you're going to like what you see. Anyway, all right, so let's go ahead and dig into CRM here. That's Salesforce.com. So as always, we're going to take a look at the price consensus and EPS surprise chart on Zax.com. Then we're going to look at the detailed estimates page to see what some of the other analysts are saying. And then finally, we'll look at the Yahoo Finance options chain. That will let us know a decent bearish trade and a decent bullish trade we could put on. And then I'll give you my opinion of which one of those I think is going to work out. You don't have to follow my opinion. Just throwing it out there for you, all right? All right, so now let's go ahead on Zax.com and take a look at this price consensus and EPS surprise chart. So what do we have here? The black line represents the price that corresponds to the right y-axis. The different color arrows are earnings beats when they're in the green and earnings misses when they're in the red. The length of this arrow signifies the magnitude of the beat or miss. Now, these multicolored lines represent the evolution of our Zax consensus estimates over time. So you can glean several things from this information. First and foremost, we can see here that they have lofty expectations to start the year, and then things start to crank on down. Lofty expectations, crank on down. But what analysts, or I guess what investors are liking about this, is the growth numbers. The bottom line is, if you see gaps between this is earnings growth, right? Now, one thing to point out here, because I know this chart looks like, oh man, look at these huge growth numbers here. We're linear on the side, right? So if you go from making nothing to making 10 cents, and then making 20 cents to making 30 cents, and then 30 to 50, right? It looks crazy when you start to get up here, but that's just because this is linear, okay? So don't get too excited. While this may look like growth is exponentially getting bigger, it's really not. And the other thing here is these estimates have turned down a little bit throughout the course of this year, and the stock has been choppy, going from 59 to 84, just chopping around. And then during the Trump rally, which I'm going to call it the Trump rally because post-election sort of move we've seen here, non-existent for these guys. So they're just not participating while we're hitting all-time highs in the Dow and things like that. These guys just aren't playing, even though you do have some spikes in the volume here. So there's more people in the game here, but it's just not happening. Now, I know here on Salesforce, let's go to the detailed estimates page for Salesforce. You see they're going to report after the bell mañana. Okay, so it's pretty quick. We don't have a ton of time here, but that's part of the reason why I wanted to get this in and get it done on Wednesday. Still want to give people a little bit more time. I'm debating, though, on whether or not we only do these like Monday, Tuesday. regardless of when the stock is going to report, right? Tell me what you think about that, though. If you guys think a few days ahead of time would be good. Again, livetrader@zacks.com. This is kind of an experiment here. This is an evolution, an evolving sort of process that we have here. We're not 100% sure what you guys want to see, so the feedback is welcome here while we're still kind of, feeling this thing out and see where we want to go with it. So I definitely want to see that from you. All right, back to the detailed estimates page here on zacks.com. And we can see that it is, in fact, the Zacks rank number 3 hold. Value style score of F. That just basically means this multiple is going to be crazy. Growth score of A and momentum of B. Okay. So again, like I said, PE 313 times earnings right now. Yeah, that's some growth. Hoping for growth, right? But if you look at this, sales estimates, I like to look at this revenue growth. So year-over-year growth estimate, 23.6%. That's good. That's solid stuff. But now let's look at the actual EPS. So why is this Zacks rank number 3? Well, over the last week, you got one analyst that's come out and dropped their EPS estimate for the current quarter. One has done the opposite. One's increased their estimate, but that was 60 days ago. If you look at next quarter's numbers, again, 60 days ago, somebody dropped the number. One person dropped for the current year. One person went up for the current year. And then over the last 7 days, I suspect it's probably the same one here. Dropped their numbers for next year. But what was the effect on our Zacks consensus estimate? You see, 90 days ago, we were looking for 6 cents. Now we're looking for 3. Next quarter's numbers have gone from 8 cents down to 6. Current year number from 26 cents down to 23, ticked back up to 24. And next year's numbers have gone from 57 down to 50. So it's really the next year part, I think, that is the most concerning about this, is why were we so excited and then it came down. But then again, remember, this is a stock that does that sort of historically. We've seen lofty estimates early on, and then they kind of peel it back, right? It happens with a lot of stocks. It doesn't make it a good stock. It doesn't make it a bad stock. It just is what it is. So you got to look at the sort of historical perspective on these, and that's why I like that price consensus and EPS surprise chart to see if you can see any sort of pattern that may be developing. Now, I do know that when a stock is trading at 313 times earnings, that they're definitely going to want to see growth. It's all about the future. They may not care so much about what's happening this quarter, but what is next quarter going to look like? What's the quarter after that going to look like? And in a stock like this that hasn't participated at all in this sort of Trump rally, it does make me a little bit nervous. I'm not going to lie. Because with so many stocks on the way up, you got to wonder, how come this one isn't following it on the way up, right? And something you need to consider, okay? All right, so let's go ahead and dig into the options chain here on Yahoo Finance. Hopefully they're giving us some decent quotes here, and they're not, because every once in a while we get a bad data feed, but it's been rare. It's been rare. So as always, this is what I do. Take a look at the stock price. Stock's trading 73.71, okay? So I open up the straddle view, and I look at the front week contract. In this case, it's the monthly expiration, November 18th, which is right around the corner on Friday. And then we scroll down to the at the money call and put, okay? And of course, we're not getting something. What did I tell you? This is just my day. Let's see if we can refresh this and get this to reload for us. Come on, Yahoo, you know you like me. So we're also going to go, I think we can look at Google Finance too, right here, just in case this one isn't gonna pull up for us. We could do the Google Finance as a backup, right? I think they have an options chain for us that we're gonna pull up. All right. Somewhere there's a bunch of crickets making a ton of noise. All right, yeah, we're not getting that feed here. Okay. Great. Of course. We're going to do this the old school way, folks. So glad this is the first feed of the day back from Sunny Isles Beach. All right. We're going to go ahead and pull up this Google Finance piece. try and find an options chain here. I hope they can give it to us. If not, the other one is bar chart. I could try bar chart and get an options chain. This is what you call redundancy, folks. You got to make sure you have it because sometimes Yahoo wants to be mean to us. You know, this is how Yahoo gets rejected. This is how I stop using it when they do stuff like this to me all the time. You can't tell me that these 7350s haven't traded because I just had it on my computer that they were trading. All right, E-Trade's another way I could go too. We're gonna go ahead and pull this up. I wonder what the answer is gonna be to this question, Alec. All right, let's see if we can get, all right, CRM. Now, of course, when you're trading at home, I definitely suggest that you get a real-time trading platform that's going to allow you to go ahead and pull up quotes on all of these in a live options chain so that you won't have to worry about any of this. So give me these options quotes. Come on, bar chart. Come on through for your boy. Come through for your boy. We're going to get... we're going to do the same thing here. We're going to go ahead and look at the at the money call. We're going to look at the at the money put. We're going to go ahead and add up the two of them, and that'll give us a decent idea of the implied volatility. There we go. There we go, bar chart. All right, now the reason why I use Yahoo Finance is because it's usually cleaner, right? But that's okay. This is what we're going to do here, folks. So I'm going to point it out for you with my color here. Okay, so use the big fat one so we can see what's going on with these tiny little numbers. So the 7350 call, you can see last traded at 250. Here's the bid at 245, the ask at 253, and the midpoint 249 essentially. All right, I'm just going to use 250 here because it's an easier way to do this. So 250, okay, on the call side. Now I'm going to go ahead and clean this out for us and dip on down to the puts. And again, you want to look at the same strike price. So the 73.50. And similar story where the bid's 244, the ask is 253, 248 was the last one. So midpoint 249. I guess we'll call this, you know, so you take a look at this. 250 and 250 essentially. So the $5 move essentially is what's being priced in here on options for CRM, okay? All right, so now that $5 move divided by the strike price, which is the 73.50, implies a 6.8% move here on shares of CRM on earnings. Because again, they're going to report after the market closes on the 17th, and then you're going to have one more day of trading, okay? So when I'm looking to put together an options strategy here, I would be looking to, if I did want to mess around with this expiration, because there is a lot of liquidity there, I'd be looking to sell premium here because there's going to be so much juice that's priced in on this move that it can be advantageous because it's such a short period of time. So if I could make a trade and have it turn around in one day, for me, that's better than having to wait a couple, 2-3 weeks and see, you know, where it goes because it could go against me, right? Now, the only problem with that is now if there's some sort of major market event that happens on Friday and you're just in there, I mean, you're just going to get stuck in the wash, right? You got no way of hiding, no way of letting the market recover or go one way or the other. So there's certainly an element of risk that's involved in that, and typically I don't like to do that. But I say we give this a shot given the huge amount of liquidity that's available on these contracts. Now, what I mean by the huge amount of liquidity is going back to this bar chart here. The bar chart numbers. All right, let's go back. Here's the call. Let me see if I can get a straddle view here, side by side. Look at that. Oh, that's prettier. Maybe I'll start using this instead of Yahoo since they keep doing that to us. Okay. Look at some of these numbers for open interest, right? On the put side and the call side. So you can see at the $70 strike on the call side having 5,800 contracts. 4,600 on the puts, then there's 5,000 there. 8,500 at the 72.50s, also on the put side. 7,500, you got almost 10,000, right? Here's 13,000 down at 77.50s, and the 1,033 down there. Okay. So there's a lot going on here. There's a lot of open interest on these. Now, I'm going to go all of these strikes. This is going to widen the scope of this so it doesn't end at $69 because if you take a look at the stock at 73.50, which is essentially where we are, that's the strike we're looking at, and you subtract $5 and you add $5, you're going to see you're going to be 78.50 to the upside and 68.50 to the downside. So let's take a look at where those strikes line up here. So those sort of 68.50s. And the 78.50 is perfect. It's the last one on the screen, which, okay, so I kind of can't do that like I want to. It's there. She's over here. It's over here, boys. All right. It almost looks like a smiley face, right? Anyway, so that's kind of the realm that we're in. No, I don't want to save this. That's the realm that we're in, boys. All right, so now if I'm looking to put together a bullish trade on CRM, essentially what I want to do is I want to sell a put spread here, all right? Because you want the stock to go up, you want all the people who are betting against it to lose money. So the people that are betting against it are going to be buying puts. So why not sell into that if you are, in fact, bullish on shares of CRM. Now, again, the stock is pricing in like a $5 move right now. So one strategy I like to do here to give myself a little bit of a cushion is I'll take a look at half of that move, half of what the market is expecting, and go in the opposite direction. So what I mean by that, so as a bull on this stock, I would take that 73.50, subtract 250 to get me to $71, right? So then I would sell a $71 put there. It's one way to do this. So if I look at the $71 puts, 5,000 contracts have traded today. That's a lot. That also has 5,000 of open interest, which is nice, okay? And I can also see a nice little chunk here at 70. Oh my goodness, what's happening here? Go away. So you see a nice little chunk here too, with 4,600 at the 70. Now, when you're putting together a put spread, why do you do something like this? The reason why you do a put spread and not just sell a put is because when you sell that put, now you have unlimited risk. Well, you're limited to the entire price of the stock, right? So if I sell a $71 put and the stock goes to zero, I owe $71. And when you're talking about selling a put for $1.50, that'd be terrible. Of course, you're assuming the stock goes to zero, right? But you see what I'm saying. Now, you can limit that risk by buying a put a little further out, right? So in this case, if I sell the $71 put, I could get $1.56 for it. Well, $1.50 now, because we're going to look at here we have a bid in the ask here on the options chain. So this is a bid in the ask, okay? So essentially the midpoint of this is $1.50. Midpoint of this is $1.20. So what I could do is I could sell the 71 put for $1.50. I could buy, while simultaneously buying the $70 put for $1.20. So my net credit is going to be 30 cents. See, plus 30 cents. So you got 30 cents in your pocket, and the amount of money that you're going to have at risk is the difference between the strike prices, which is $1, minus the amount of premium that you got in your pocket. So the 70 cents is what you're going to have at risk. So in this case, on this trade, you could potentially make 30 cents on 70 cents for a return of 42%. And that's going to happen real quick. That's just over the course of a day, right? You only got to hold it, well, a day after earnings, right? So that's why there's risk involved here, because if shares of CRM dip below $70, you're going to lose 70 cents, okay? So again, this is definitely a trade that has a bullish bias, as long as it stays even or goes up, you're fine. Okay, so that's how you make money on that trade. The short 71.70 put spread for a net credit of 30 cents. Okay, that's the fancy way to say it. Or a bull put spread is another way to say that. All right, that's the bullish case. Now, what's the bearish case? Again, let's construct this in the same fashion, where you look at 73.50 and add 250 to get you to $76, right? So if I'm bearish on CRM here, what I want to do is I want to look at 76 on the call side. Take a look at that. And another, it's again a similar construct where we could sell the 76 and buy the 77. Now, what does this do? So if I sell the 76, again, we got to get back to these midpoints. All right. So we sell the $76 call for $1.34, right? Sell that for $1.34. And then the $77 call, we're going to buy it. That way we don't have unlimited risk to this trade. Because if the stock goes to a bazillion, you're going to be on the hook for a bazillion minus the 76 where you sold that call. We don't want to have that risk. We want to clearly define our risk, and that's why we're using options to play around with this. So if you buy the 77 call, it's right now it's trading 96 by 102, so 99 cents is where you should be able to get a decent fill there. So now what does this trade look like? So I sell the $76 call for $1.34, but I buy the 77 call for 99 cents. So subtract the 99 cents. And here you've got 35 cents in premium that you've taken in with 65 cents at risk. Now, how do you lose that money? You lose if shares of CRM trade at or above $77 at expiration, which is Friday, right after they report earnings, okay? So that's kind of the scenario here. So if you are, in fact, bearish on this, you're going to make that 35 cents as long as shares of CRM are below $76 at expiration, okay? So that's the game plan there. And that's good for 53.8%, right? Pretty nice if you can get that just in a couple of days. Now, in the past, I've done these things where I put on an iron condor where I'm short both of them if I don't think the stock's going to move much. This is in the range. I think this one's going to move a little bit. Okay, I do. But on Salesforce, on CRM, am I bullish or bearish with regards to this earnings options play? Yeah, in this case, I'm going to be a little bit bearish on CRM. And really, it's because of the price action that we've seen already. It's not a strike against the company. It's not a strike against the fundamentals. I see the EPS kind of creeping down. That doesn't bug me too much. The growth number's still there, but how come the stock hasn't done anything while the market has been rallying? You'd think that if I was a big-time money manager that was very bullish on CRM here, that while all these other stocks would be going bonkers, I'd be secretly jumping in and buying as much as I could, and we've not been seeing that. So people are avoiding the stock, so I think I'm going to avoid it too, and I think that maybe I can take some of this optimism out of this market by selling this call out of the money, and I think this may work out, okay? I think this one may work out. So I'm going to put on the bearish trade I'm looking at here. The short 76-77 call spread. If I were bearish, that would be I think that would be the way to go. So that's a bear call spread is another way to say it. Selling the 76, buying the 77 for a net credit of 35 cents. All right, so thanks so much for hanging out with me today here on CRM. I apologize for the technical difficulties, but I bet you that doesn't happen again because I'm going to switch up styles here. I think we're going to use a different site, so I think it's going to work out. Again, I will, any questions, comments, concerns, livetrader@zacks.com. Make sure you get signed up for all the premium stuff, including that review video where we talk about all the trades that we put on throughout the course of the week and what they look like. So, Why don't you guys circle back in about 5 minutes? I'm going to be talking about Foot Locker and giving you an idea on a trade that you can make there. Again, Dave Bartosiak here with Zach's Live Trader, and I'll catch you guys in about 5 minutes. Thanks.